Welcome to the RevRec Gals podcast, where two consultants with over 30 years combined experience share stories about the implementation and challenges of revenue recognition accounting. I'm Susan.
And I'm Natasha.
And we are the RevRec Gals. Welcome to this episode of the RevRec Gals. We are going to continue our case studies, as we are calling them. This time, we are going to go into the 10K of a company we know, but we've never worked for. We don't know what's in their 10K, and talk about the information that they're finding there and what the implications are for revenue recognition and why they might be reporting in such a manner. Today, we are looking at the Form 10K of Levi Strauss, dated for the fiscal year ended November 26, 2023. Subsequent to our recording of this episode, Levi Strauss has come out with their 10K for fiscal year 2024. While the numbers are different, the general reporting structure of their 10K appears to be very similar to what we discuss in this episode. I hope you enjoy it. The Levi Strauss Company, who is an all-American brand that started out making denim jeans for the gold diggers and has expanded into different areas of clothing. With that, let's get started.
I had no idea that they started out making jeans for the gold diggers. That's a fun fact.
So their brands include Levi's, Dockers, Dennison's, Signature, and Beyond Yoga. According to their website, in 1853, Levi Strauss, an immigrant from Bavaria, opened a dry goods company in San Francisco at the height of the California gold rush. While he was working, he recognized a need among hardworking people, clothes built to endure anything. He and a tailor, Jacob Davis, combined copper rivet reinforcements with tough denim, leading to the first manufactured waist overalls in 1873. Today, we call them blue jeans.
Oh, wow. So they invented blue jeans.
They did. And now you know why you get a little copper rivet on the edge of your pockets. It's to keep them from ripping.
Things you didn't know that you'd discover while recording a revenue podcast.
Let's get started looking at their 10K.
Usually when I go to 10K, I immediately start with the MD&A, the management discussion and analysis. So that's what I skipped to. And I was just scanning through it, and where they're talking about the seasonality of sales, which I think is, whenever thinking about a retail company, is one of the first things that I think of, is that there's a lot of seasonality in retail, particularly in the fourth quarter related to the holidays, which we just came out of. We see right here, they're talking about, we typically achieve our largest quarterly revenues in the fourth quarter, and goes on to disclose the percentages of revenue for each quarter, which is sort of interesting.
They're reporting significant information related to their company, which a lot of other industries would not record. If you're in software or hardware, you don't have that level of cyclicality, or maybe you do, in which case you would need to report on it.
They even we typically achieve a significant amount of revenues from our DTC, direct-to-consumer channel, on the Friday following Thanksgiving Day, commonly referred to as Black Friday. Due to the timing of our fiscal year end, a particular fiscal year end might include 1, 2, or no Black Fridays, which could impact our net revenues for the fiscal year, which makes me wonder, what is their year end? Fiscal year ended November 27th. So that's super interesting.
That means they have a 445 calendar, which, for those who don't know what a 445 calendar is, the week always ends on a Saturday, and you go 4 weeks or 5 weeks per month. And so you don't have a true calendar month, you have a 4-week month.
That is super interesting. I've never worked for a client that was that way.
Now, when I scroll up a little further into the management discussions, I find it interesting how they report their revenue. So across all our brands, pants, including jeans, casual pants, dress pants, shorts, skirts, and activewear, represent 68 and 67% of our total units sold. So they're combining all their pants, and then they're combining all of their tops, which is shirts, sweaters, jackets, dresses, and jumpsuits. And then they also segregate by men's and women's products. This is their form of segmenting their reporting. So that's how they're segregating their reporting, because these are significant differentiators. So men's and women's products, that would make sense. But it's interesting that they separate out tops and bottoms as well.
Yeah, that is super interesting. I would have thought like it would be by sales channel or something. And maybe they talk about that later. There's no kids, which is interesting because there's definitely kids Levi's products.
But I guess it's not significant enough to represent its own segmentation.
Yeah, that makes sense. And then as we go down, the next paragraph talks about the different regions. Europe and Asia businesses collectively contribute 43% of our net revenues.
And then they also separate it by channel. So they have wholesale channels, DTC, which I believe is direct to customer. So there's another. So direct and indirect, that's pretty common. And then they also carve out the e-commerce as a portion of the direct to customer and report on how much revenues are from that channel.
And that is how I would have expected it.
I'm a little surprised because it's less than 10% of their total net revenues. And usually what I see is people look at that 10%. But given that e-commerce is such a big thing, it does make sense, even though it's less than 10%, to call that out so people understand they're doing a lot of their business in physical stores.
That's actually surprising to me. The company operated the e-commerce business representing 20 and 19% of direct-to-consumer channel net revenues and 7% of total net revenues in 23 and 22, respectively.
I guess they're managing to keep their storefronts busy. But it does make sense sometimes because, at least for me, jeans and swimsuits are two of the things I like to try on because you never quite know how they'll fit.
Well, and it's also interesting because this is globally too. So maybe the culture of online shopping is different in different regions. And maybe it's also specific to their target demographic. Maybe, to your point, the swimsuits and the jeans, they're targeting people who want to come in person. It does go on to say their global digital business, which includes our e-commerce sites as well as the online business of our wholesale customers, including that of traditional wholesalers, as well as pure play online only wholesalers, represents approximately 21 and 22% of our total net revenues. So that's interesting. I'm just Googling what is typical for retail sales, around 20%. So that's reflective of like the standard. Yeah.
As we scroll down, I do see they have a comment here about Russia, Ukraine, which is pretty common. I think most companies have been required to disclose how much relates to the Russia-Ukraine crisis.
Yeah, I think most of the companies that I've worked with have had some sort of disclosure.
Now, this is interesting. During the second half of 2022, we recognized a 15.8 million gain related to the early termination of certain store lease agreements. So they actually closed down some stores, but they also recorded an impairment. Total charges of $60.4 million. The charges reflect the full impairment of long-term assets. So that's not really revenue related.
Yeah, but I mean, I think it's an interesting thing because I also just think from an overall financial statement evaluation, when companies are doing restructuring like that, it's a place where they can kind of put a lot of junk in there. In that, like you can write off a bunch of stuff. You do one big restructuring and if you're having to do that, it's just something to pay attention to because then after that, you might get some rebound in performance that may not be reflective of going forward. So it is interesting to note, particularly when we go down to look at the revenue numbers, like how was their revenue impacted? Let's see what they have in their actual financial statement disclosures for revenue. So if we go to the financial statements and supplementary data, I think it's good to look at the critical audit matters just to see. Often revenue will show up there, but it looks like they just had a Goodwill thing.
I like to go through and look at how they're reporting the revenue. Like if you go to net revenues, they've broken out Levi's brands into the regional, Americas, Europe, and Asia, and then they have a separate line for other brands. And when we look at other brands, they are primarily from Beyond Yoga and then Docker stores. Those are the two that are called out as being other brands. So Levi's is such a big portion, it gets its own reporting line.
Yeah, so we're still in the management discussions. This is really representative of how management looks at it. It's not even what's required from a full reporting perspective from like the financial statement section. This is how does management look at their business? How do they break it down? Which often is more interesting because it's not subject to the same sort of stringent requirements.
It's also probably what people are asking about. One thing I also find interesting in here is in Europe and Asia, they're reporting both on a direct US dollar basis and a constant currency basis. Constant currency means they've stripped out the impact of the foreign exchange.
Yeah, the increase and decrease has a constant currency. So if you kept the foreign currency constant, what would the change be? That's super helpful. It's really interesting, actually, because you look at Asia, and from a constant currency perspective, their revenue growth was even higher than is reflected in US dollars. And I mean, not as significant, but the decrease in America and Europe is slightly bigger. That is a really interesting way of looking at it.
That's where I like to also look, is just see how are they reporting and segregating their revenue for reporting purposes.
Here they talk about it in each region. They look at that fluctuation and even provide a little bit of context on what it's related to. If you look down at other brands, for example, and the increase in net revenues is driven by increases in revenue primarily from Beyond Yoga related to increase in e-commerce traffic and store expansion. So it's like there you get the explanation of why are these increases happening? What are they related to?
Yeah, it's quite detailed. I'm not used to seeing quite that much detail in a 10K or 10Q.
Well, it might be a retail thing.
True. Page 69, we talk about sales returns and allowances.
Oh, let's talk about that. So when I think about retail revenue, I'm tempted to think it's simple. You sell a thing, you recognize the revenue. Transfer of control happens at the register, and that's it. But I think in reality, it's always a little more complicated than that. And I think the big one that I think of in retail is returns and rebates. Susan, I know you've seen that a lot in your experience. Tell me what you think about maybe that in general, but also what are you seeing here that is sort of interesting or consistent with what you've seen before?
As we look through, it says these estimates are calculated based on a history of actual returns, estimated future returns, and information regarding retailer inventory levels. So my thoughts on that are actual returns. You can look at your history, but estimated future returns, maybe there's a line of new Levi's that you've put on the market that just aren't selling. And so you may have to take these back from your retail stores, or you may have to liquidate them or sell them to a secondary reseller or something like that. So you may have returns, especially since they have wholesale. They may have situations where the wholesale channel potentially could have an inventory refresh and rights to refresh their inventory. And so there might be some sales returns there. That's where I look at this information regarding retailer inventory levels. If something's not selling, it needs to come back and they need to figure out some other way to get rid of it. The retail stores I've worked at, they actually have third parties that will take extra inventory at a very discounted rate and then turn around and resell it, or they may ship it overseas and sell it overseas.
Is that the sort of TJ Maxx and Ross's of the world?
Yeah. But then also there are resellers that will send it to other countries and then sell it for really low prices. If you see those Levi's in some foreign countries' flea market, it's potential they came through those
types of channels.
Yeah.
Interesting. So one thing I think about too is you talked about using the history to estimate going forward. But to your point, there could be an event or something that happens currently that would impact those estimates. So I think of I don't know if you remember, was it Lululemon a few years ago, the whole debacle with the see-through leggings, right? And so all of a sudden you have this event that happens that changes the number of returns in a way that's kind of dramatic. Maybe there was an issue with a batch where the fabric ripped very easily, or maybe there's something that's impacting the quality, or even just from a PR perspective, there's some sort of backlash where you have to update this.
It's interesting here because they go on to say, we recognize allowances for estimated discounts, retailer promotions, and other similar incentives at the later of the period in which the related sale is recorded or the period in which the sales incentive is offered to the customer. Maybe they have a big July promotion, like maybe during Amazon Prime Days, they have a big promotion and they set aside a reserve knowing that they're going to be providing this additional discount. And then when those sales come in, they're going to relieve that reserve to offset those sales.
That's super interesting. It's so hard to read these because you have to read it so specifically. It says promotions and similar incentives, that I could buy something today. And so there's a sale recorded today. There might be an incentive today, but maybe it's saying if you come back in 2 weeks from now, there's a new sale.
This is what we talked about before, the gap cash, the bounce backs, those coupons that get you to come back in the door. They're going to do a small reserve knowing that a percentage of all of those discount coupons or all of that gap cash is actually going to be used against a future sale. And so they'll put the reserve on the books and then they'll relieve it when that sale is made. Given the volume here, they're probably going to have to do some estimates to determine how long, or in the case of a bounce back coupon, it's good for a certain amount of time. So they can say, we have this reserve. It relates to this period of time. We're going to release it during this period of time when that incentive is available to the customer.
Well, and I also sort of wonder if sometimes the sale happens second. The incentive is provided to the customer, like maybe they mail me something, and then, but the sale doesn't happen until I actually come into the store and use that incentive.
At the time they mail, they would put a little bit of a reserve on the books, knowing that you're going to come in later. But not everybody they send it to is going to come in. So they have to do this estimate. And then at the time where they project you would come in, maybe they have a history of, from the time they send out these coupons, within 3 weeks, people have used them or they're not likely to use them. Maybe they then release it 3 weeks later or something like that.
So that was for estimated discounts, retailer promotions, and other similar incentives. So that was specifically related to sales incentives, not necessarily returns, which are kind of different animals, right?
Yes. So typically you would have 2 different reserves on the books. Interestingly, also, they call out that these estimates are calculated using the most likely amount method, which we've talked about in other episodes.
But the most likely amount method is binary, right? They either get it or they don't.
No, most likely they would estimate approximately how much they're likely to get. Because with all of these sales, it's hard to track that one person you sent the coupon to coming back in the store and actually using it.
Yeah, and it's typically could be a wide range of results. You might get an incentive that if you spend more than X amount, you get this off. If you spend more than this amount, you get 25% off. Like it could change.
I'm guessing, though, that they have enough history that they can reasonably estimate what percentage of people are going to use that coupon and how much time it takes before they come back and use it.
Also, interestingly, so when they're coming up with these estimates, I would think that in some way you have to consider macroeconomic factors such as how did COVID-19 impact your business? How does, for certain regions, how does the Ukraine-Russia war impact the way your consumers are interacting with you? But even just macroeconomic factors about our economy and political climate, all those things could potentially make it go one direction or the other.
They answer your question. So under this method, certain forms of variable consideration are based on expected sell-through results, which requires subjective estimates. These estimates are supported by historical results, as I was speculating before reading this sentence, as well as specific customer and product-specific facts and circumstances related to the current period. The determination of sales allowances is considered a critical accounting estimate because significant judgment is required to estimate sales volume and demand. Actual allowances may differ from estimates due to the size of sales volume based on wholesale customer or customer demand and changes in customer and product-specific circumstances. So they've called out here, they know this is significant judgment, and they have to look at not only history, but where do they estimate their sales volume and demand to come from? And that's where those market factors are going to play in. If you have COVID, your estimated sales volume and demand is going to go down. If there's a sudden new wave of interest in Levi's and they're just selling off the shelves like crazy, your estimated sales volume may go up. Or maybe you have, 100 or 200 new stores, your sales volumes and demand will go up just because you have new stores. So that's really an interesting paragraph there.
I mean, I think it's always interesting for retail companies, inventory valuation impairment is so important and how that lines up with your revenue. I mean, obviously we don't go into that, but I do think that's kind of interesting.
I think it's also interesting. They report currency across 18 different currencies, 19 if you include US, which surprised me. I don't usually see that level of detail for currency. I usually will see maybe 5, and especially because there's only maybe 4 of these that are significant.
Most of the companies that I've worked with are software SaaS companies. And so you're dealing with a headquarters, and typically you're dealing with a particular industry or groups of industries that might kind of collect in similar regions. And so I sort of wonder, maybe because of that, you have more concentrated currencies and concentrated regions, whereas with retail, your retail shops have to be everywhere.
Maybe. But if these are the ones that they're tracking, then that kind of would make sense.
Okay, so we get to our financial statements, right? And there's the critical audit matters. Looks like it's focused on goodwill there, so nothing about revenue. On their balance sheet, as looking from a revenue perspective, I'm always interested in their AR, trade receivables, which are not insignificant probably from their wholesale business. So when I think of retail, I don't think of AR because I think you collect cash in the moment, but ultimately they have a big wholesale business, right? So you're still going to be in a position where you're evaluating collectability, where you're having some sort of reserve for collection issues. I think we've had an episode on it before, trying to distinguish between what is a collection issue versus a return that we just talked about can be a sticky area. And then finally, we get to the income statement on the next page.
They're making money.
Yeah, and their revenue is increasing. Good job, Levi. I think if we go further down to the notes, so there's accounts receivable. Company extends credit to its customer that satisfy predefined credit criteria. AR is recorded net of an allowance for credit losses, estimated based on an analysis of the aging AR, assessment of collectability, including any known or anticipated bankruptcies, customer-specific circumstances, and an evaluation of current economic conditions. So that's where that current economic conditions gets evaluated there.
So looking at history and then also looking at the current circumstances and in detail at your customers.
Yes. And like those anticipated bankruptcies, I think particularly in the retail space, those are usually headlines. And maybe they have a sense of it even just based on their sell-through with those potential customers.
That's a good point, because the Macy's and Bloomingdale's, as they close stores, that impacts Levi Strauss.
Yeah. And I mean, Toys R Us isn't going to impact Levi's, but that was a great example of one that made headlines and had a big impact to a lot of different companies. And everyone was talking about it at the time. Here we go, revenue recognition. Net sales include sales within the wholesale and direct consumer channels. So finally, we got the DTC definition confirmed. Wholesale channel revenue includes sales to third-party retailers such as department stores, specialty retailers, third-party e-commerce sites, and franchise locations dedicated to the company's brands. So they do have a franchise model.
Now, this is what I find interesting. Revenue transactions generally comprise a single performance obligation, which consists of the sale of products to customers either through wholesale or direct-to-customer channels. They satisfy the performance obligation and record revenue when transfer control, which we've talked about, has passed to the customer based on terms of sale. Transfer control passes to wholesale customers upon shipment or upon receipt, depending on the agreement with the customer. So here's where we talk about our Incoterms and our delivery terms.
So that specifically, I think what you're referring to is the contract with each one of those wholesalers is going to say transfer of control or risk of loss and title transfers at shipping point or delivery.
Sometimes if you're going international, there are all kinds of like before it goes through customs, after it goes through customs. So you got to look at those Incoterms and see when is transfer of control defined to occur.
And I've actually had a client where the struggle with that was really pretty massive. At some point, they lost the ability to track it effectively. And so they had to kind of come up with an estimate. Well, most of the time, it makes it through customs in approximately 6 weeks. So they had to come up with some sort of estimate. Luckily, it wasn't a significant part of their revenue, but it can be a painful.
Here's something really interesting. So within their direct-to-customer channel, control generally transfers to the customer at the time of sale, within company-operated retail stores and upon delivery to the customer. Now, what's interesting, it's upon delivery to the customer with respect to e-commerce transactions. When you order, they don't consider it delivered until you receive it. So if you don't receive it, then I'm presuming they have potentially insurance or something going on and then would resend you without charging you a second time. So I think that's really interesting because I always wonder, like, I didn't get my shipment, and they're like, oh, well, we'll resend it to you because we can't find it either.
To a certain extent, they probably have to have some sort of assumption around delivery such that if their delivery partner, UPS, FedEx, USPS, whoever it is, says it's delivered, they recognize revenue. But I'm sure their customers were like, I never received my package. I don't know what's going on. And so there's some amount that they wouldn't be able to rely on. So I wonder how they estimate that or track that, if it's even significant enough to matter.
I'm sure they would have some kind of estimate, probably based on historical experiences.
Or to show, even just to show it's so immaterial, it doesn't matter. Like, yes, this happens. This is how often it happens. We're not going to adjust our revenue according to this.
Another thing interesting, they have licensing revenues.
I know, I was seeing that. That's super interesting. So licensing revenues are included in the company's wholesale channel and represent approximately 1% of total revenues, which are recognized over time based on the contractual term with variable amounts recognized only when royalties exceed contractual minimum royalty guarantees. My guess is they have wholesale agreements who are actually producing products using the Levi's brand. That's the way I understand that. And then when they say they have the contractual minimum royalty guarantees, my thought there is they have a contract with these partners that say, at a minimum, you're going to pay me this much per month, per quarter, per year. And they're recognizing that probably evenly over that period of time. However, if they go over that contractual minimum, there's a variable amount they would get paid more than that minimum.
Yeah, so it'd be interesting if they're accruing variable consideration related to this, or if they just have the recognition as the royalties exceed those minimums. It would really depend on how often it exceeds and what those minimums are.
Well, it's interesting the way they phrase that. The variable amounts recognized only when royalties exceed, which is interesting because I would think at the outset of the contract, they would have to come up with an estimate and recognize it over the contract term.
If you have structured your contract where you've priced it based on what you really think is going to happen, like maybe it's not necessarily a royalties where you're committed to a minimum and everything over it you have to pay us. It could be, here's your maximum. And if you go over this maximum, then you owe us.
Yeah, like the maximum is so high such that they don't really expect them to go over it. And therefore, they don't really have to estimate.
Or not regularly.
And then the other thing is maybe they do, depending on the structure of these deals, maybe they meet one of the exceptions related to variable consideration where you can recognize that variable consideration in the period in which it's incurred because it's reflective of the allocation objective or only related to that period of time. So they don't get into the detail here, but I'd be interested or curious in how they got there.
They do mention their top 10 customers and what percentage those make up of their sales.
I think that's kind of the interesting stuff.
Well, that's a wrap for our review of the Levi Strauss 10K. This concludes our episode. Stay tuned bi-weekly as we talk all things revenue recognition. You can be notified of new episodes and other information by following us on LinkedIn. Feedback and topic suggestions are always welcome through LinkedIn or by emailing us at revrecgals@gmail.com. Thanks for listening. The examples discussed are based on specific company dynamics. Check in with your auditors before making changes to your current processes. Specializing in revenue recognition may result in employment for life. Please consult your friends and family before pursuing this career.